hardly need to tell you that we are living in extreme times, and we are getting extreme predictions. And in fact, the more the kind of times we are living in, the social media, which has become the mainstay now, our primary source of opinion, news, information. More extreme views on each side, on all dimensions, seems to be gaining more attention. Uh, of course, it's the most extreme times we have seen in our lives, and I'm here with my set of questions for Mahesh. In normal times, I ask him, "What are you doing? Uh, what to expect?" and all that. Of course, those are perennial questions. I'll have those questions too. But this is a very unusual time. So I have just listed a set of questions which make me wonder that are we going to be in a completely different world? So without wasting much time on the introduction and anything, I'll just get started. Thank you, Mahesh, and welcome. Uh, I have a lineup of 10, 15, 10 to 12 questions for you. And one is that the spread of COVID-19 has deepened in the country. We are getting an extension of the lockdown every other day. And we are waiting patiently for the Prime Minister's announcement. He's setting up an appointment with us in one evening and giving us a roadmap. Uh, how unusual is this, how unusual is the sustained recovery of the markets, because market is going in a completely different direction. And what is happening, the real situation in the market, what we see in the world around us is completely different from what is happening in the market. So what is driving it? What do we make out of it?
Yeah, let me wish all our viewers a good evening. And so, just to take back in perspective, at the beginning of this calendar year, things were looking fairly good, right? For the global economy was recovering. We have seen that the global risk appetite was coming back. And in general, the huge liquidity which was there globally was supposed to take the markets and economy higher. And so getting into this, when COVID first broke out news in China, people thought it was going to be limited to China and nobody thought that it will spread all over the world. But as the pandemic started to grow in proportion and moved from China to Asia, then to Europe, USA, India, we saw that the market started to take note of it and started to wonder whether it's a very serious pandemic. And that's where I think suddenly at that point in time, until then, I think the market was fairly complacent. There was low volatility, and in the last couple of years, we've seen a huge amount of money going into bond funds. Then there are these risk-adjusted funds which are there, which play on walls. So there was a lot of leverage which was there, and suddenly when this thing broke out, we saw a panic selling which was there, and a lot of these bond funds and risk parity funds, as they call it, they started to unwind, and the selling was ferocious. I mean, we saw in a matter of 2-3 weeks, the market corrected by almost 35 to 40% across the world, and that led to the initial sharp reaction. And in India also, we saw that there was $8 billion of outflow in the month of March. So that was the initial reaction. Then I think this time around, I think
what we saw in the March, in the month
what we saw in the month of March, yes. And so this time around, I think unlike during the same, we saw a crisis which was the last we remember is the global financial crisis, right, when the markets corrected sharply. So that point in time, after the Lehman crisis, it took some time for the central banks to come in and come with the policy response. But this time around, with hindsight in mind, we saw the central banks globally, whether it's the Fed, the ECB, the Bank of Japan, everybody reacted pretty quickly and announced a stimulus package. US cut interest rates down to zero, and huge liquidity was infused. Also, the governments globally came into action mode and decided to announce a large fiscal stimulus package. I mean, the fiscal stimulus package, most of the countries have announced a tune of around 8 to 12% of GDP, which is almost twice what we had in the global financial crisis. So I think the response was pretty swift, and as a result, the market rebounded from those lows, and we saw almost 50% retracement of the fall. Typically, that's what happens. Okay, when you see a large sharp fall, market rebounds, and then during that period, also what happened was there's been discovery across the world. People are trying to find a solution for this disease, and there were a couple of companies, one company in US called Gilead, which announced that they are working on an antiviral drug, remdesivir, which is found to be effective against COVID patients who are terminally ill. It reduces their mortality rate. And that gives a hope that probably you would have some kind of a remedy coming in soon. And there were various other combination drugs which were talked about, like HCQS and azithromycin. So all that led to a hope rally in the market, and that's the reason why we saw the market rally about around 25% or so from the bottom. Having said that, I think that's what happens. There's initial bounce back, then reality sets in. Okay, you take stock of the situation, how things are in the economy, and then market takes its normal course.
What, in your opinion, looks like this can linger? This is a crisis which has, is disease, and its impact can linger, and and it can linger for months. It can linger for years. So, how bad can things get for the economy? Because right now, just liquidity, which has been, introduced in the, has been reinforced, but the world has come to a standstill. So, in that sense, how bad things can get for the economy?
So this is a crisis, I think, which we've not seen before, I think, in our lifetime. And it's virtually, as you rightly said, it's the economy coming to a standstill, right? Both on the supply side issues as well as demand side disruption. And the impact on the economy in the near term period is very, very severe. And so we've seen every business, every industry is getting impacted because of this lockdown. Because the only solution to tackle this virus is social distancing and lockdown, right? There is no other way. So that is, except for a couple of sectors like pharmaceutical, basic consumer, utilities, telecom, everything is getting impacted.
Yeah.
And that will take its toll on the economy. We are seeing the estimates which came in initially. Initially, one thought that the impact would not be that much. You will see a soon recovery, a V-shaped recovery. But as we got to know the virus much better, the way it's spreading, and the mortality rate, and the lockdowns are getting extended, I think there has been a significant cut in the growth estimates. So just to give a number over there, globally, we were looking at this year, the global GDP was supposed to grow at around 3.1%. That number is now being cut anywhere between -3 to -4%.
Mm-hmm.
That's the kind of a cut we are looking at. In India too, I think we were looking at a GDP growth in FY21 to be around 6% or 5.5 to 6%. That number now, if you look at a couple of the economists which have reported numbers, they're anywhere between -1 to -3% in that range. That's a kind of a deep cut in the economic growth. We haven't seen that in India, kind of a decline even during the global financial crisis.
From a growth economy to a shrinking economy.
Yeah, yeah. And it will be, right, I mean, this quarter will be very bad. The growth rate could be around 15 to 20% lower. As we come out of the lockdown, slowly things will start to come to normalcy, but we'll start be back to normal. Second quarter, okay, it will still be negative, probably 10%. Third quarter, mild negative, and fourth quarter is where I think we can expect things to start to come back, okay, in positive territory.
Mm-hmm.
That's the kind of situation we are currently looking at.
It all comes with a rider that how things shape up from here on.
Sure. I mean, we have to take it as we go, right?
Yeah. So, you have been you're a professional investor for a long time. You have interacted with businesses, met them, understood their business. And the kind of, life we have lived in the last 7-8 weeks, it's a complete change of the way we have lived ever, and unlikely we'll live ever in future, or maybe things change. So, do you think it's going to, do you think, structural change in the way the businesses are run, or the service component of the businesses, or India being a service economy dominantly, any structural way which you visualize that businesses will change forever?
I think whenever we come out from any crisis, I think we come out a bit different. I think there are changes which happen both in the industry also, and in terms of how we conduct things. I mean, this is kind of a event, okay, where we see a lot of social changes which will happen, and that will impact the way we do businesses, okay, how we conduct ourselves. Uh, a prominent changes what we see is because of social distancing. I think we have adopted to working from home as a compulsion, and slowly and steadily, I think it will become a way of life, right? And we have realized that yeah, one can continue to work from home with the same amount of productivity in a lot of sectors and services without actually getting impaired. I mean, like in our case, right? We are working totally from home, and there has not been any problem in terms of our efficiency. And I think that will continue. And in fact, a couple of companies like Twitter recently said that they will ask 100% of the employees to work from home
Yeah,
for
work from
right
home
for this
completely.
period. And so each company will try to calibrate and see, okay, how much the employees can work from home. Like IT companies, TCS has said that they would look at around 40 to 50% of the employees working from home. And that would mean not only for companies in terms of trying to cut down on their costs, and also productivity could go up because the travel time, in especially metro and the city, is much larger. But when you're working from home also means that there's a kind of changes which you will have in your lifestyle, right? So there'll be demand for a lot of home improvement products, okay, which could be there. You will probably want your home to be air conditioned if it is not. So demand for some of these things could go up. Also, people are starting to become much more independent, right? Self-reliant. I mean, you don't have your mates and others. So you need to have other devices, okay, at your home, okay, which will improve your efficiency. So demand for basic consumer goods, consumables, whether it's a washing machine uh, or other home appliances, I think you could see a demand for that go up. So that's one kind of change which we see. Also, I think coming out of this, I think social distancing will continue to be there because the virus will be prevalent, and and people will be really worried in terms of getting into crowded places, malls, multiplexes. So I think the way we go out and have our food, entertain, I think that would also change. And I think we saw a pickup of shared mobility, right? Ola, Uber, okay, that was the trend. I think you could see a reversal of that in some way as people who want to have their own vehicles and want to avoid public transport. So the demand for own vehicle, whoever can afford, could go up for two-wheelers. But the bigger change I see is on the digital side, right? Because everybody is now working home, trying to adopt digital, and a lot of businesses have been forced to do it or are doing it out of choice, and companies which are able to adopt digital as a part of their business. Okay, it's not only for on the operation side, but is also on the supply side, supply chain side, as well as on the front end in terms of customer acquisition. I think they would be able to differentiate much better and be able to come out much stronger. So these are some of the changes, okay, which we see. Also, I think people have, after all these things, I think the demand for protection will go up, right? When you see this crisis. So you would see demand for insurance, right? Whether it is life insurance, health insurance, and general insurance, I think that would also increase.
Day before yesterday, our prime minister announced that big headline stimulus, which is 20 lakh crore. We have never, it is unprecedented. We have never heard of anything of that kind. And yesterday, and it is still being announced. It is underway. While we talk, the second conversation from the finance minister will be on. Yesterday, we got the first tranche of it. And even before RBI took some initiative. And let's see how things evolve. But do you think, this is good enough based on what we saw yesterday?
So, like stimulus, I mean, looking at the crisis, okay, and the kind of a slowdown, what we're looking at, and not knowing, okay, how long it will take us to recover. I think any kind of a package would look small, but I think what the finance minister and the prime minister have put out together is a decent package. If you look at it's comparable to some of the large packages which some of the global economies have announced.
Mm-hmm.
And we have seen first tranche of that come in early on, okay, which was trying to address at the bottom of the pyramid, trying to send money at the hands of the poor, the rural population. Then we saw a lot of liquidity measures taken by RBI, which were announced, and the package which was announced yesterday tried to address the problem of the medium and small enterprises, right, which are going to be at the forefront, okay, at the front, both in terms of their businesses, in terms of liquidity.
Mm-hmm.
So up till now, we have seen a total of the 20 trillion rupees of package, which is 10% of GDP. Around 14% has been announced, and the MSME package, okay, which provides a credit guarantee to around 3 lakh crores of loans, okay, which can be disbursed to MSME sector, which is pretty substantial. It accounts for almost 15 to 20% of the total MSME credit, which is able to ride them for the next.
Quite significant.
Right? And to that extent, it helps to avert the problem in the banking and financial services and the NBFC sector in terms of NPAs. So that, I think, to large extent gets addressed. Also providing liquidity to the NBFC sector. So I think this is the first one. I think what, and the good thing is that while this doesn't have too much of a fiscal impact, right? The total cost of this is just around 80 basis points. But I think the second tranche of the package, which will get announced today or in the next couple of days, has to be really addressed towards stimulating demand. Right? Incomes are going to get impacted because of this crisis. So you have provided liquidity and survival, but you also have to take care of that. And demand stimulus in terms of trying to direct benefit transfer or cash transfer to sections of the economy which are getting directly impacted. Is in budgetary allocations towards, say, the housing sector or the infrastructure sector to boost demand. Those are the measures, I think, which one would like to see, which could be actually hard for fiscal stimulus and which could probably be another 2% of GDP.
Okay. You did highlight some of the changes that will come about, and we are in the middle of this big economic pain with the economy on a standstill for so long. But what kind of specific opportunity that you are looking at? Every pain comes with some opportunities getting created. You listed some of them. Can you elaborate more on that?
So the opportunities, okay, can be one is, I think, for a country as a whole. I think it's going to be, I mean, as the Prime Minister mentioned, right? Every crisis can be an opportunity, and how you take it. So I think what I'm more looking for, besides the fiscal stimulus package, okay, what kind of a reforms come in? Because I think we'll come out of this crisis over the next 1 year or so, but going into that for long-term sustainable growth, I think if you're able to take this adversity, and that's what the Prime Minister said, and if you're able to usher in a new phase of reforms, I think then the long-term sustainable growth of India looks much better. I think the Finance Minister hinted at reforms in the land and labor, right, area, which is pretty significant. I think what opportunity is coming in for India is that we want to be self-reliant, right? So PM talked about Atmanirbhar Bharat. So it's not only import substitution, but I think what has happened in China, the trade wars, and post-COVID, a lot of global manufacturers are trying to diversify their supply chain from China into other countries. And for India, it's a big opportunity. If they're able to attract some of the large investments over here, then I think that can provide us another fillip of growth to our overall GDP.
Economic growth that can.
Yeah, I think that is, something which is a big opportunity. Already, I think bulk of the measures have been done in the last 5 years. We have seen the ease of doing business going up, right? We have seen the tax rate being brought down to 15% for new manufacturing. So that is fairly attractive. On the logistics side, also a lot of improvement has happened in terms of the rail, road infrastructure. The dedicated freight corridor will be commissioned in a year's time. So what was remaining was only reforms on the software issues like land and labor. And then also we've seen some of the states like UP and Madhya Pradesh have recently come out with notification where they have said that the archaic labor laws need not be adhered to for new companies which are wanting to establish over the next 3 years. So I think if you're able to really crystallize this and identify a few sectors, okay, be it in areas like chemicals, it could be in textiles, it could be in consumer electronics, in IT, in pharma, okay, for manufacturing of basic raw materials. I think that can be a big opportunity for India, which can create a long-term growth driver for economy.
Manufacturing economy getting a big boost. Mm-hmm.
So that's I think from a country, that's a big opportunity, okay, which one is looking at. Uh, as a portfolio manager, right? I think the opportunity is, I think in this kind of environment, clearly the companies which are having a strong balance sheet, which are much focused onto their businesses, have got a strong competitive advantage. I think they will continue to become stronger and bigger.
Mm-hmm.
Companies with leverage, uh, whose cost structures are much higher, will get squeezed out in this environment, and some of them will perish. Some of them will barely survive. So some of these stronger companies with strong brands, strong
That's
balance.
a broad framework you're operating in. That stronger balance sheet is something to go with.
Stronger balance sheet, stronger competitive advantage, cost advantage, stronger brand. I think
Advantage. Okay.
these will be the companies, okay, which will survive, and that will be across sectors, right? I mean, sector-wise, there will always be various sectors, okay, which could look better, but I think that could be a broader theme which we would like to
You know
adopt.
what? We are in the middle of this crisis, and we don't know the time frame. We don't know the pace of reversal back to normalcy. What kind of time frame, with what kind of damage, with what kind of uncertainty in terms of labor, or the kind of state or the production base where it is. With that in mind, how do you actually, where do you derive your conviction from with so many variables being completely uncertain?
You're right. I mean, we are in a period where there's a lot of uncertainty. We don't know how the virus spread will be, whether there will be a double dip, okay, which could be there. So I think in this kind of an environment, it's while we keep on looking at the day-to-day changes and tracking the near term, I think one has to look slightly beyond this. Okay, which are the sectors, which are the companies which will come out of this stronger? I think that clarity has to be there, and I think as I mentioned earlier, within sectors there'll be winners. Okay, which will be able to navigate this situation much better. They have a stronger balance sheet. They have the right management, okay, which will be able to address issues. And yeah, I mean, a couple of quarters, okay, will be bad. That is a given. But coming out of this, which companies will be strong? I think it will be much more stock specific, is what we are looking at. At the same time, which are the sectors which will start to emerge first coming out of the lockdown, right? There are certain sectors, okay, which on the consumer side, which will come back much earlier. So that could be one of the sectors which will be looking at. Apart from that, other sectors where social mobility, okay, will restrain people from going, like in malls, theaters, they will take a longer time to come to. So I think it will be a more calibrated approach across sectors, how normalcy will be. But I think apart from that, it's clearly the same companies, okay, strong companies will again come back, and one needs to actually wait for the right opportunity, okay, to buy these. I think the crisis is providing us opportunity to buy good companies at a reasonable valuation.
At a reasonable valuation.
Yeah, and that's what I think we are trying to identify in this environment.
So validating all your hypothesis now in terms of what will but with all the uncertainty. Now the way you have functioned in the past, like getting up in the morning, get ready to reach office, have your morning meeting, and decide what to buy. Of course, all those routine would have undergone a change. But is there a fundamental change in the way you manage your funds? Have you started asking loudly some key questions which you never used to ask? And what are the results of, what is the result on your, uh, what are these key changes translating into changes in your portfolios?
I think even before this, right, we were looking at our whole investment process. Okay, what are the changes? Okay, we need to do,
Mm-hmm.
and more so after this crisis, I think some of these things are being crystallized. So every crisis, I think, gives us an opportunity to look into our processes and see what needs to be strengthened, We did that after the global financial crisis. Okay, we in 2010-11, we strengthened a lot of our investment process around stock idea identification,
Mhm.
portfolio construction, around risk management, and that helped us in the next 8 to 10 years, and we've seen that improvement across all our funds. I think getting into this crisis, also we had a tough year, last couple of years, and that enabled us to really look into some of our processes and look at where we need to strengthen. And while doing that, we came up about a couple of action points. A, when you are and doing stock identification, when we are evaluating a company, normally we would look by the numbers, right, which is important, okay, earning. But I think we sometimes miss the trees for the forest, right? So we need to really get the narrative part for a company well, because we missed stocks in the last 2 3 years. Many companies which were good companies, but we missed them because the valuations continue to expand. We've seen a few sectors or a few new generation high growth sectors where the multiples were very high. And that
Mhm.
was a problem with our philosophy of growth at a reasonable price. So we thought, okay, let's have a narrative for a company where we ask questions, right? What is the right to win for this company, right? What is it, key thing which will drive this company, not in the shorter term, but in the longer term? How will it continue to grow faster than the industry? And getting the narrative right is important for us to really back a company, not just looking at pure numbers. So we started doing that for each and every company in our investment universe. Other thing what we see is during
Has
the
it translated into a substantial pruning of your portfolio?
yeah, so that's the next step, okay, which came in that once you start to really focus, because in the last few years we had seen our investment universe had kind of expanded quite a bit, right? We got a lot of companies because the market was growing, but then we realized that okay, we need to probably get much more focused. And once you start to filter your stocks through all these filters, okay, then the investment universe comes down. So we have consolidated our investment universe significantly to bring in a sharper focus. And what we realized in the last few years, and especially after the NBFC crisis, management quality, and during those times, we saw a lot of companies with poor corporate governance or management issues were suffered quite a bit. And that's when we tried to build some management evaluation framework in terms of our overall stock selection process. Management, and we've seen in the last few years, markets are willing to pay a premium for good quality management. And management is what really drives the company from a long-term perspective. So build a strong framework in terms of how to evaluate management, both qualitative as well as quantitative factors, and brought it as a part of the investment process.
Mhm.
That is something which is one more dimensions, okay, which we are using while evaluating a company. And we've tried to build in a slightly longer term focus for looking at companies, especially high growth companies.
Mhm.
So it's important to visualize not just the next 1 or 2 years, kind of, but next 5 years. Okay, what is likely to be the growth and how the market opportunity will grow, and that has enabled us to identify companies which are very early stage of their growth cycle. Which might some of these stocks could be in the retail sector where they might look very expensive, and we would have avoided that earlier. But we have a better framework to now look at these high growth early stage companies as a part of our investment universe. So these are some of these changes, and besides that, we have strengthened our risk management framework. We have also overall at the portfolio level, also we have consolidated our holdings. So we have seen that our portfolios, the number of stocks had gone up, and last couple of years the market breadth was very narrow, and that hurt us. And then we looked at what is the right number of diversification is required in a portfolio, right? And that led us to tune down some of our holdings in the portfolio, and brings. We don't want to run a very concentrated portfolio. We want to maintain diversification because that's again a part of the risk mitigation strategy. But clearly, there was room to bring
Not too diversified.
tail in the portfolio. So
Long tail.
these are some of the changes and learnings, okay, which we have incorporated in our SIP,
I
and that
was looking at your, sorry, Mahesh. I was looking
yeah.
at your the portfolio of the focused fund, and it has 10 to 12% cash? Is it a tactical or opportunistic? Is it meant for tactical or an opportunistic buying right now?
So I think in this current environment, when there is uncertainty and we expect the market to remain volatile in the near term because we still don't know how the virus curve, especially in India, is still not peaked out. It's good to have some amount of liquidity at hand.
Okay.
That gives you opportunity because we see this sharp correction in the market and stock prices tend to fall much faster. And it gives you opportunity to buy stocks at a very attractive price. Also, the focus fund is a more concentrated fund, okay, where the
Yeah.
stock concentration is much larger, and that makes it much more volatile and much more riskier.
Other funds may not have this larger cash allocation.
Yeah, so other funds would also have, but not to that extent what we have in
That,
the focus fund. So it's more of a tactical short-term strategy for us to manage the current uncertainty and take advantage of opportunities, okay, as they come in.
we are in the middle of this crisis, and it might be a little premature to talk about, the turning point of this crisis. But every time every turning point, we see that sector leadership changes after a major crisis or after a major inflection point for the economy, for the market. You know, after the global financial crisis, BFSI or consumer-led rally, whatever we saw. So the market leadership of the companies of the leading sectors, what was driving that the market before changes. What do you think will be the big change this time?
So I think you're right. I think every decade we see some of the new sector emerges. Last year it was in the last decade it was to some extent the banking and financial services sector where we saw its weightage increasing, almost doubling over the last 10 years. Then there was quality and consumer sectors which came up. I think this crisis would also lead to some changes in the next decade. As I said, this would be totally different, right? As I mentioned, it might not be sector specific, while there are a few sectors, okay, which we think will do well for the medium term. For example, pharma is a sector where we are positive, and the sector has underperformed in the last 3 years. Domestic pharma is doing well. Government focus on healthcare, insurance would mean that you see a long-term sustainable growth on the domestic pharma side. And Indian companies have also really transitioned on the US side from generics getting into complex generics. So I think that will provide an opportunity again in this environment. This is a sector which is the least impacted. That sector looks good. Then again, consumption, I think in India will going to be a long-term story because of the demographics, right? And especially low-ticket consumption, right, where the penetration levels are still very low, and as per capita incomes go up, as we see the electrification in villages goes up, the desire to buy consumer durables and other items will go up. So that's another area where we see long-term structural growth. Near-term, the consumption could get impacted, but I think as things normalize, and also government is trying to put money at the hands of the bottom of the pyramid, right, where there is a propensity to consume more, especially for these small-ticket discretionary items. That's a longer-term theme which will continue to do well. Apart from that, I think the banking and financial services sector would also do well. I think there will be some shifts there. Probably you would see the insurance and other sectors which are non-balance sheet led. I think you would see stronger growth. Again, penetration levels are much lower over there. So that could be another sector which could emerge within the banking and financial services sector. And I think other areas which are some smaller sectors, right? For example, chemicals and other areas where India is now, again, what's happening in China in terms of moving off a lot of supply chain over there. And Indian companies have got the expertise in terms of chemistry. So I think that could be another sector, okay, which could emerge. But I think going across sectors, I think it will be important to see going forward. I think within sectors, there will be companies which will adapt much better, right, to the changing environment as we discussed. Okay, what are the changes? What we're seeing environment? Who will adopt technology better, right? Who will to redefine their businesses.
Mm-hmm.
That disruption is happening across sectors, whether it is in the retail sector, whether it is in the media sector, whether it's in the banking sector, right? Uh, so companies will be able to adopt that change, okay, adopt digital as a way of life, are able to use data, right, effectively, okay, to mine data and to do analytics on that, to understand consumer behavior and target, okay, and specific consumer needs.
More precisely.
Those are the companies I think which would emerge the leaders going forward. So it's going to be a mix, okay, across sectors. I think some of these companies which will transcend this change, as well as some of these other sectors, okay, which could be the next drivers of the rally going forward.
Companies which adapt better will do well. Okay.
Yes.
Given all this, what should be an investor's expectation from equity funds near term, which is next within the next 1 year and next 5 years? Interest rates have come down to where they are now. So what should be an investor's expectation over the next 5 years and 1 year?
So I think from a near-term perspective, clearly, I think markets we think would remain volatile. We've seen the markets move up, okay, after the initial correction. We are still not out of the woods. We're still seeing the virus curve, what happens after the lockdown, whether we have a next wave. So that will keep the market in tenterhooks, and you will see ups and downs in the market. But clearly, I think, and again, because of the sharp impact on the economy, we are seeing a sharp cut in earnings also. So this year, the Nifty earnings growth, which was initially expected to grow at around 20-22%, is now being cut. And I mean, the consensus is now at around minus 4 to 5%, but we could probably see more cuts over there. Mm-hmm. So virtually, we are going 1 year behind, right, in terms of growth. But again,
1 year is a write-off for us.
Yeah, in a way, right? And to some extent, some of the demand will get deferred, okay, into going forward. A lot of consumption demand, especially for discretionary, will get deferred. So you could see a bounce back in FY22. But clearly, I think we are seeing significant cut in earnings. And post that, I think in an environment where there is uncertainty, it's best to look at the trailing earnings, right? Mm-hmm. So CFAL and price to book value and other parameters of valuation become very important. So after the correction, and especially when the markets corrected back all the way to 7,500, we reached a valuation on the price to book value and market cap to GDP, which was kind of an all-time low, right? What we saw during the global financial crisis. So clearly at that level, the market was looking very, very attractive from a longer-term perspective. And we've seen whenever anybody buys at those valuations, the returns in the next 2 to 3 years are much larger than the long-term average. Mm-hmm. However, we have now bounced back from those levels. We have seen a 20% move. And currently, the market valuation, while the price to book value is still attractive. On a PE multiple, we are now closer to around, if I look at the trailing earnings, we are around 5-6% lower than the long-term average. So clearly, our starting point is attractive in terms of valuation. And going forward, if you write off this year, I think the long-term growth as we come out of this crisis, and if India is able to take advantage of the situation and reforms, I think we can again come back to our growth rate, long-term growth rate, which is around 5.5-6% or so. That would mean that earnings, okay, for the market also would be somewhere in long-term average. So I think in this context, I would expect that the market valuations are reasonable, slightly attractive. Long term, I think you can expect returns to be around 12-13% from these levels. In the near term, I think the market will remain a bit volatile. So I think that's how I think we would look at. I think investors coming in at these levels would advise to spread out their investments over the next 3 to 6 months. Is looking at the volatility, but clearly this is the time to start increasing the equity allocation.
Mm-hmm. Getting back to the most important question, that what is the asset allocation? If you have, of course, this is a traditional question, but these are extreme times. So if somebody has all the money right now And if he has to spread his money around in terms of equity, debt, which kind of equity, which kind of debt, wherever, how will you spread your investment? Assuming that it is your long-term portfolio and you have your money to spread, how will you allocate it?
So I think as I mentioned earlier, the market valuations are slightly attractive. The starting point is good. So one would have a slight bias towards equity, right? So your asset allocation equity, if typically you are having 50% debt, 50% equity, I would say one can increase the allocation slightly. And if the markets from here, one can increase that further. Within equity, I think clearly the bias would be towards a large cap fund. I would say because at this point in time, we've seen a decent correction in the large cap stocks, okay, which had continued rally for the last 2 years, and provide much more stability to the blue chip companies. And the resilience power is much more better, and so a larger allocation to a large cap fund than a multi cap fund. So I think large cap and multi cap can be around 75% of the allocation. There could 15% allocation to mid and small cap. The mid and small cap will remain uncertain from a short-term perspective, but the valuations there are fairly attractive. The mid-cap index is at a 6-year low, and long-term investors, this is the time to build some exposure over there. 50% allocation can be a thematic fund, okay, which can be fund like a banking, the pharma and the healthcare fund, which launched around 9 months back. It can be a consumption fund like Gendex fund of ours, or it can be an MNC fund, or even banking and financial services fund in the next 3 months. I think during the crisis, whenever we have bought this sector, it has done good returns.
I was expecting a slightly more precise thing, because if I have to do all that, I would rather go for your frontline equity fund.
I mean, what can always come in through the asset allocation fund, right? We have an asset allocation fund which does the asset allocation across asset classes and within the category. And for investors who are slightly averse of volatility, they can look at the balance fund of the balance advantage fund, right, where the equity allocation changes dynamically.
Does investing in international equity make sense? While the whole market, Indian market collapsed, we saw a far greater resilience there. And how upbeat are you about that? And
so in fact, international investing in international equities has been rewarding in the last 10 years. It's given almost 3-4% higher return than the domestic market. And that's not suggesting that going forward we'll continue to do that. But it does show us that investing international markets as a diversification, I think makes a lot of sense, especially investors who already have a large exposure of domestic equities. But also for somebody to participate in a lot of sectors where you can't invest in India. Okay, these are in areas of technology, some of the new generation companies, which is happening. Even from our portfolio perspective, also we are looking at few of the international stocks. So we did some experiment in our dividend fund. In India, we are finding difficulties finding high dividend stocks.
So all the mainstream fund are finding, these international stocks are finding a way in there.
Yes.
Okay. Thank you very much. I'm being given a notice that it's time to close now, and Mr. Talib is trying to connect. So I look forward to listening to him. And thank you very much, Mahesh, for sharing your perspective.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.